Hello and welcome back to our Talking Points, where we gather the top experts in their fields to discuss the important points relating to investment and in particular investment into property. Now, for those of you watching our recordings for the first time, firstly, welcome. Each week, we're going to be diving into an aspect of wealth creation to show you how to use other people's time, money, and skills to start building your very own investment portfolio. And to top it off, we're going to give you a free training, but you'll have to stick around to the end of this video to get more information. Now, for today's talking point, we are joined by Destinata Properties General Manager, Emile Grobbelaar. We'll be sharing a little bit more information about the rising interest rates and how that is going to affect your investment portfolio. So, Emile, thank you so much and welcome back to our talking points.
Hello, Damien. Great to be back.
Now, Emile, it's a good start to the year, but obviously we're seeing a lot of changes in the interest rate, which keeps going up, and you're predicting a further increase later this quarter. So in our recent past conversations, you seem to be very focused on the cash flow of a property portfolio. So you can just give us a little bit of information about why that's important.
Yeah, Damien, obviously, when the interest rates were much lower, then obviously our properties cash flow were much better. It rose substantially from 7% now to 10.5% prime. So that's got a negative impact on cash flow of your portfolio, but not only your property portfolio, but personally as well. So a lot of people could carry the shortfalls previously. That's been going up and up and up, but they keep on forgetting that their personal costs also increased with that same prime interest rate. So it's a double hit that they're taking, and if you don't keep an eye on it, then obviously by the time you pick it up, it's going to be too late, either on your personal name or on your investment portfolio. So it's very, very important to right now focus on that, keep an eye on it, and also with new acquisitions for the portfolio, to keep that in mind together with what you need for the portfolio. It's not always going to be the high capital growth type right now. You will need to alternate between the cash flow property and the refinance type property.
Now, Emile, obviously the rising interest rate obviously has a negative effect on the cash flow. But according to you, are there any advantages to this?
Yes, of course. For investors, very, very great, good, positive point is that a lot of the people that could afford to buy and obviously bought during the times when interest rates were low, they now will be entering the market as tenants again. They might have bought at the brink of their affordability and cannot afford the property anymore, need to put it back on the market, sell it, and need to rent again. So a good quality tenant is coming back into the market, which obviously an investor want. And then always, maybe not such a good thing, bargain type properties will be coming onto the market. So for investors, you can buy below value. Some people are under pressure financially, maybe waited too long before they made a plan and are perhaps behind on bond, etc. So bargains might pop up in the market, so keep an eye on those. Those will obviously be a second-hand purchase. In other words, it might be a very good cash flow type property that you can buy at a very, very good value. And obviously, if you buy below value, then you can refinance it later on, early in your ownership, up to the value of the property again. So you can buy very good capital value, but also very good cash flow.
Now, in your article, you also mentioned that two-bedroom apartments or townhouses, as well as student rentals, are in strongest demand at the moment. So which one do you think would be best to buy for someone who is currently in the market and looking to buy an investment?
Well, Damien, the one with the best return. The difference is the student accommodation, specifically in the strong student hubs like Stellenbosch, for instance, they're very expensive. Your rate per square meter that you are paying in Stellenbosch is possibly around 65,000 Rand a square, where you can buy somewhere else a two-bedroom apartment or townhouse, which will be a 20,000 Rand per square cost. But the net return is the one that will ultimately make the decision for you. Unfortunately, the scale is out of balance. If you look at student accommodation, if you do pay 65,000 or 70,000 Rand a square, the rental income will not give you the return that you want. And then if you compare it to the 2-bedroom apartment, you will probably get a better return on that. So that is where you need to make your decision. The cost per square, in my opinion, at the moment for student accommodation, brand new, is just too high. Second-hand, you'll probably pay a little bit lower, towards the 40,000 Rand per square. But once again, your new developments at the normal 2-bedroom apartments is much, much lower than that. So that is where you need to make your decision.
Well, now on that note, we all know that the biggest risk with any investment for property and long-term rental is the tenant and the vacancy of the property. So what are the risks with a short-term rental, for instance?
Damien, yeah, with regards to risk on tenancy in short-term rental, obviously you don't really have such a big risk when tenants, might occupy the property without paying the rent. But if that does happen, the normal legal eviction needs to happen. But one of the biggest risks that's been happening the past few years is if you do own the property in a complex where the body corporate initially allowed Airbnb or short-term rental, at AGMs these days, a lot of them decided not to allow it anymore. So suddenly you will lose that business, and the cash, because it's a very strong cash flow positive business, suddenly disappears from your income. So the risk there is that the complex will decide and might decide to stop it, and then you are forced to stop that type of business, and you will have to move towards long-term rentals. And yeah, that will be very, very big impact on your cash flow.
And then on the point of risks, while we're talking about it, what do you think is the best way to alleviate any sort of risk on an investment portfolio?
Damien, yeah, I would say the best ways is to do the vetting of your tenant properly. That is where you prevent problems later on. If the property is vacant, you need to place somebody. Yes, you can do that by lowering the rent per month that you require, so you will always be able to place somebody. But the risk comes with placing the wrong tenant. So vetting the tenant properly is where you alleviate that risk.
Fantastic. Emile, thank you so much for your insights. I think the bottom line of what your message is to emphasize the importance of weathering the storm versus just jumping ship when things are looking rough. So, I mean, we've been through similar cycles before, and I think the stats over the last 50 years speak for themselves, which is that property is still one of the best investment classes. But if you watching at home enjoyed today's video and you'd like to find out more, or if you'd like to understand what we do at the Wealth Masters Club, then click on the link below the video to register for our upcoming training. There you'll get access to a 2-hour masterclass on investing in property using the correct structures. But for now, that's all we have time for. So thank you once again for joining us, and we'll see you again very soon. And Emile, thank you again. Bye-bye.
Only a pleasure, Damien. Keep well. Bye-bye.